Hey, it's Jim, and this is level 1 of the CFA program, the topic on economics and the learning module on exchange rate calculations. I'm guessing you're as delighted as I am that the Institute doesn't begin this kind of a reading with pages and pages on how to exchange one currency into another currency. But just for kicks and giggles, as my cousin says, let me just make sure you understand what an exchange rate is. And then I'm going to ask a couple of questions before we look into the LOSs. You know, for example, here I am in the United States. If it takes $1 US to buy $1 Canadian, which of course it doesn't now, but if it were to be a one-to-one relationship, well, then we would just take $1 and convert it into $1 Canadian, and then we would have that rate of exchange. Now, over time, that exchange rate changes because, look, it's the price of one currency in terms of the price of another currency. So just like the prices of stocks and bonds and credit default swaps change on a daily basis, so will exchange rates change. So at some point in the future, it takes 1.1 US dollars to buy that same $1 Canadian, then we say the US dollar has depreciated. And so this is not really part of the LOS here, but there are bits and pieces of it in here. So there are essentially two reasons why exchange rates change over time. And this is an important time to learn this so that we can apply it to more deeper conversations, especially in level 2. Two reasons. The first reason is trade. Imports versus exports. You know, the United States, we send lots and lots of stuff up to Canada, and Canadians, they send lots and lots of stuff down to the United States. So the relationship between imports and exports, that trade, will determine the value of that currency. The second component is the level of interest rates in both countries. And we'll see that specifically inside of this learning module. So remember those two things, trade and central bank behavior or interest rates in both countries. So let's look at these LOSs, and there ought to be 4 of them. Calculate and interpret currency cross rates. We'll do that here in just a second. But then look at the next one. There's probably 3 of them in there. We'll explain arbitrage. This is a concept in which the investor requires no capital, that there is a positive expected return, and there's no risk. That's the definition of arbitrage, and we'll talk at length about that, not just in this learning module, but also throughout the CFA program. And then we'll go ahead and calculate a forward rate, and then interpret the relationship between the forward rate and the spot rate. We'll call that a forward discount or premium. So I want you to look at those. You know, really, how many are there? There's just 2, but really you could probably do 4 in total. Maybe even 5. There are 7 or 8 questions at the end of this learning module, and they specifically address these calculate. So let's get our calculator out. We'll do a little bit of math here in the learning module, but you'll need it for those handful of questions at the end. So this is what I was saying earlier. Let's start with spot rates. So what the Institute does for us is it doesn't really waste our time about that one-to-one relationship that I was talking about just a moment ago. What the Institute does is say the following. Suppose that we have one exchange rate between 2 currencies and another exchange rate between 2 currencies, one of which is identical into this first exchange rate. Well, how do we back into that other one that's not common in that relationship? So this is called a cross rate. And this is super easy math here, and all we're going to do is we're going to multiply so that we can get some final answer here. So let's work through a quick example. Let's take the relationship between the South African rand and the Chinese yuan, and then we have another exchange rate between the South African rand and the Russian ruble. So notice, look in those first 2 diamond points. You have ZAR and CNY, and in the second one you have RUB and ZAR. So what we want to do is we want to arrange the math so that the ZARs cancel, and we're left with rubies per yuan. And that 3rd diamond point just shows us there. So put the ruby per ZAR multiply that by ZAR per CNY, the ZARs cancel. You can see the math right there. So look at the example at the bottom. If the first exchange rate is 148 and the second exchange rate is 164, notice that the ZAR, that South African Rand, is in the numerator, and in the denominator they cancel. So you get, well, what is that answer? 2.4484. Now, let me go ahead and warn you that the Institute has two ways of presenting exchange rates inside of the body of this reading. However, it only uses one of them. It uses this thing right here on this slide in all of those 7 questions at the end of this learning module. Now, the other one is for the Institute to say, hey, let's do a euro $, and that's the way you'll see it in the reading. You know, the word euro will be spelled out, and then a little dash, and then a dollar, DOLLAR. What that means is that the US dollar goes in the numerator, so that's US dollar per euro. So it's a little bit confusing there, so I don't want you to get confused on the exam, but here's my advice. Since the Institute presents it in this form on the questions at the end of this learning module, I'm guessing that that's a signal that it's going to put it in this form. So this is the form that we've decided to use throughout this slide deck. Now, let's suppose that we have different exchange rates. So look down at the example here. We've got the RUB per ZAR as 148.76. And then let's throw the Japanese yen in there, the JPY per ZAR, that's 70.74. Now look, I want you to, and this is why we bolded it in red, if you were to multiply the 148 times the 70.74, notice what you would get in the labels. ZAR is in the denominator of both. So you would be multiplying 2 ZARs in the denominator, so you get ZAR squared. So of course that makes no sense at all. So what we need to do is invert. And this is a big section in the learning module. I'm not quite sure why the Institute spends so much time. Let's just go ahead and invert it. So let's do the 1.4876. Put that in your calculator and then just hit your 1 over x button. And you get the 6722, which is now ZAR in the numerator and RUB in the denominator. So now look at the bottom. Now we can multiply because the 2 ZARs, they cancel, and we get, what is that? Almost 48 Japanese yen per Russian ruble. So remember, here there's an example where you can multiply. This is where you have a common currency in the numerator and the denominator. Here, if you just multiply, you'll have a common currency. In this case, it's the ZAR in the denominator, but you could also have it in the numerator. And if you multiply those, you'll get that currency squared. So that's why the Institute goes through this whole thing about inversion. Now, this is what I teach my students here. I tell them, look, if I give it to you like this, just go ahead and multiply. If I give it to you like this, go ahead and divide. You don't really need to go through the whole inversion process. You just need to divide. So look, if you were to take the 70.74 and divide by the 1.48, you're forcing the ZAR to be in the numerator and the denominator, and they cancel. Now, what was I saying earlier about arbitrage? So triangular arbitrage, what do we say? No capital, no risk, but yet a positive return. If there are discrepancies, here, let me just go back here. Let me go back one more. If there are discrepancies in the cross rates, remember we got these 3 currencies where one is kind of an outside currency, right? If there's a discrepancy, then there is an opportunity for triangular arbitrage. So let's work through a quick example here. Look in the gray box. So if we have this Japanese yen per Canadian dollar, 85.98. So we take those 2 rates, the 1.3 and the 1.11. We can just multiply those so we get the 85.98. All right, so there we go. From given, at least in the question stem here, but in practice, given rates of exchange, cross rates, right? We get this 85.98. Well, look at the very bottom diamond point. If a misinformed dealer simultaneously offers. All right, so think in that gray box, that's kind of like a theoretical value, but that 86.20, that's an actual value. So what are we saying here? In the gray box, we're saying that it ought to take 85.98 yen to buy one Canadian dollar, but some misinformed dealer is offering 86.20 Japanese yen per Canadian dollar, which is different, right? Those two numbers are different. So there, of course, is an opportunity for triangular arbitrage. So what are we going to do? We're just going to purchase one Canadian dollar for the 85.98 and then immediately sell it to that misinformed dealer for 86.20, and there's a risk-free profit of 0.22 Japanese yen per Canadian dollar. So here are some of these questions at the end of the learning module. The learning module will want you to compute that 85.98, which we just did on the previous slide. Then in the question stem, you'll have to be given that 86.20. And so the question is, what's the arbitrage profit? So all you have to do really is subtract, right? We learned that in kindergarten, subtraction. Now, what did I say in the very beginning? I said that exchange rates change because of trade, imports and exports, and differences in interest rates, differences between central banks' attitude toward the level of interest rates inside of a country. Well, in that first example, what did I say? I said that you could take one US dollar and buy one Canadian dollar. This is called the spot market, and the spot market is a transaction for the delivery of a currency within 1 or 2 business days. All right, so that makes sense, spot market. We're going to use that term spot market and spot rate of exchange all the way to the end of level 3. But suppose that I want to go to Canada, but I don't want to go there for 6 months. So what can I do? I can wait 6 months, but what if that US dollar Canadian dollar exchange rate moves against me? What if I can only take my $1 and I only get 60 cents, 0.6 Canadian dollars? Oh my gosh. Well, I'm not going to have a very fun time going to Canada in 6 months if the exchange rate moves against me. That's called currency risk, by the way. So what I can do is I can go to a bank and I can say, hey, I'm going to Canada in 6 months. I would like to lock in a rate of exchange, and that's called a forward rate of exchange. So there's a tremendous spot market for currencies, and there's an equally tremendous forward market for currencies. Now this is our first dab. Can you guys just imagine you're at the pool and you're sticking your pinky toe in there to test how cold the water is? This is our first dabble into derivative securities. Oh my gosh, we're going to have great conversations on futures contracts and option contracts and swap contracts. We'll do a little bit of that in level 1, but mostly we'll do that in level 2. But a forward contract is known as a derivative contract because the forward price is based primarily on the spot price. It's derived, the forward rate of exchange is derived from the spot rate of exchange, but then you have to throw in those 2 factors that I explained to you at the beginning. Like in 6 months from now, let me start over. Today, the import and the export might be exactly the same between US and Canada. And the interest rates might be 5% in Canada and 5% in the US. But in 6 months, those 2 things might be different. Exports and imports are going to change. Interest rates are going to change. So that forward rate is based on the expectations of future trade and future interest rates. And embedded in that future interest rate conversation is a measure of inflation. Now, that conversation here has very little to do with the LOS. However, it has everything to do with explaining the arbitrage relationship between spot and forward exchange rates. This provides us with a great foundation for moving on to LOSs in other level 1 readings and especially in level 2. All right, so that forward rate, so what did I say? The spot rate between the US dollar and the Canadian dollar is 1, right? 1 to 1. But the forward rate, it could be 1.05, or it could be 0.95. The forward rate could be either above or below the current spot rate, in which case we say that there is a forward premium or a forward discount. Forward premium would be positive if you take the difference. Forward discount would be negative if you take the difference. Now, what we need to do is identify the base currency. So let me just go back here. Go all the way to the left of the equal sign, Japanese yen in the numerator, Canadian dollar in the denominator. The CAD, whatever currency is in the denominator, is known as the base currency. Let's take a look at a quick example. Actual exchange rates during the year 2023, spot rate between Canadian dollar and US dollar, 138,450. So it takes 1.3845 Canadian dollars to buy 1 US dollar, but the 6-month forward rate is different, 1.38475. So that base currency, which is in the denominator, in this case it's the US dollar, was trading at a premium to the spot rate. And if you go ahead and do all the decimals there, 1.38475 minus 1.3845, you get 0.00025. But in practice, what we're going to do is we're just going to move the decimal over. So, or you can do the math there, multiply by 10,000 to get 2.5. Those are called points. So typically what happens is that the spot rate is reported 138,450, but then the points will be reported for each forward contract. And there are multiple forward contracts. Typically we go to one decimal place unless it's the Japanese yen. So here, if you look at the spot rate for the ruble per won, 164.59, and then the maturity down there, these are forward contracts, a week, a month, 3 months, 6 months, and 12 months. Notice there's a minus sign there in front of those forwards, so we would just take the 1.6459 minus the, and then, well, you could just go back here if you have to multiply that by the 10,000, right? And so you get, you'll get that. So you could be able to compute the forward rate, and you'll have to do it starting with the spot rate and then either add or subtract those premiums. And so here's just the way to do it here. So let's go back to the 6-month rate. So we start with the 164.59. What is that 6 months? So that's 12.7. So just we're going to add, but it's a minus sign because it's a discount. So we say 12.7 divided by the 10,000. And so there you go, 1.64463. So that in blue there, that's a question at the end of this learning module. So I would make sure I would know how to do that. And then what you could do is convert that into a percentage change. And we do that for you in that blue bullet point. This is really just what I taught you back in time value of money, F over P minus 1. So F is the future, or in this case, the forward. So you take the 16459 minus the 00127, which is the 1664463. So if you do 1.64463 divided by 1.6459 minus 1, you get the, what is that, 077. And then what you can do is you can go ahead and use that number and convert it back to the 1.64463. So this is really just, I don't know, simple algebra, maybe just, not even algebra, maybe just simple math. So take a look at those 4 bullet points going down the left-hand column. The Institute could ask you any of those 4 questions. Now let's get back to what I was saying earlier about this arbitrage relationship. The difference between the spot and the forward rates, and the difference in interest rates between the two countries. So remember I said to you, foreign trade, right, and the interest rate differential. All right, so think about what could happen here. Suppose I have 100 US dollars And I could go and I could invest that in a U.S. Treasury bond and say that U.S. Treasury bond yield was 10%. So look down at the bottom. If I invested domestically, I would take my $100, multiply by 1.10, right? I sub D, that's the domestic interest rate. And so all that would give me is the 110, right? But what if I could take my $100, convert to Canadian dollars? Maybe it's that one-to-one relationship that we talked about earlier. 100 Canadian dollars, and I could invest in a Canadian interest rate. Suppose the interest rate in Canada is 20%. So I convert that and then I invest in Canada. So at the future value, I would have 120 Canadian dollars. But the question then is, what am I going to convert that back to? Well, I could just wait and convert it back to the US, to the current spot rate in 6 months or 1 year, but that exposes me to currency risk. Or I could sign, isn't this smart? I could sign a forward contract and lock in that forward rate. So if I convert those 120 Canadian dollars back into, let's say, 111 US dollars, well, then I'm better off, right? I would have had 110 here investing in the US, but 111 if I exchanged, went to Canada, made the investment, and then came back to the US. So there you go. Arbitrage relationship. The key is the availability of that forward contract, which guarantees, it locks in that future value. Now let me pause and say, you know what? If you sign that forward contract with Rock of Gibraltar Bank, right? A strong bank, it's been around for 1 million years, it's going to be around for another 1 million years, then it's truly an arbitrage opportunity. But if you sign that forward contract with Jim's bank, my bank, no one's ever heard of Jim, nobody knows how much capital I have, right? I'm a knucklehead, I don't know what I'm doing with all my money, I'm going out there and investing over here, right? Well, then there's third-party risk or some kind of default risk or something else. But here, at this point of the learning outcome statements, the Institute pretty much assumes that when you sign that forward contract, you sign it with the Rock of Gibraltar Bank. Now, here's the alternative too. This is exactly the equation at the bottom that forces an equilibrium between my first effort and my second effort. First effort was just in the US, my second effort. So notice what we're saying here, that 1 plus the interest rate down at the bottom on the left-hand side of the equal sign must equal the, now are you ready for this? Must equal to the spot rate. So what did I do? I took my $100 and I exchanged those for 100 Canadian dollars. So that's the S. F sub D, and the F is foreign, so the domestic currency is the base currency. I multiply that by 1 plus the interest rate in Canada. Remember in my example, that was 20%, right? But then I convert it back at that forward rate. So we take the reciprocal because we're in Canadian dollars and we need to convert back to US dollars. So what we do is we rearrange this. So the forward rate on the left-hand side of the equal sign has to be equal to the spot rate. Oh my gosh, let me go back. What did I say to you a minute ago? The forward contract is our first exposure to a derivative security. So what is a derivative security? One whose value is derived from the value of another asset. So forward is derived from spot. So we start with a spot, and then all we do is we compound out there. So this is nothing more than saying, hey, I have $100 today, interest rate is 10%, I'll have 110 at some time in the future, right? But now we have to consider two different interest rates. In the numerator, we have 1 plus the foreign rate divided by, in the denominator, 1 plus the domestic rate. So here's how you're going to remember this. You're never going to forget this on the exam. Look at the exchange rate. We have the spot rate. So F in the numerator, that's the foreign currency. So you're going to put the foreign interest rate in the numerator of the second part. So just remember, foreign goes in the numerator for both. Domestic goes in the denominator for both. All right, so here's just a quick example here. If the spot rate of exchange, 1.502, domestic rate 4%, foreign rate 6.2%. then all we need to do is, well, just do the quick math there. So we start with the 1,502 and we're compounding it out, right? Now, since that foreign interest rate, the Canadian interest rate, is higher than the US interest rate, in my example, what was that, 20% over 10%, then that forward rate is going to be higher than the spot rate. So we get the 15338. Now what we can do is we can continue to rearrange that stuff. Look down at the bottom orange box. We can bring the spot rate over to the left-hand side of the equal sign by just simply dividing both sides by the spot rate, and we get that thing right there. So look, this is a great relationship between spot rates, forward rates, and the relative interest rates between two countries. And so notice what this thing is. It's the no-arbitrage equation. And so if that equality holds, then there will be no arbitrage. So here's my advice for the exam. This is what the Institute loves doing. This is what I love doing as a test creator. Give you the forward rate, give you the spot rate, give you the foreign interest rate, give you the domestic interest rate, and ask the question, does arbitrage hold? And if the left-hand side is equal to the right-hand side, then your answer is yes, it does. If it doesn't, then your answer is, well, no, the forward rate is higher, or no, the forward rate is lower, whatever turns out to be the correct answer. But I want to call your attention to that last bullet point down there. You ready? The currency with the higher interest rate will always trade at a discount in the forward market. In fact, what I want you to do is I want you to pause the video and I want you to repeat that to yourself 5 times. Just go ahead, close your eyes and say it over and over again. Like Dorothy. You guys ever watch The Wizard of Oz? You know, there's no place like home. Everybody knows the words from Dorothy because we've seen. I want you to be able to remember that for level 1, level 2, and level 3. That sentence alone will help you get 15 points on CFA questions. We can continue to use some algebra and some substitutions by rearranging our equation back here at the top and at the bottom in the gray box so that we come up with a percentage change. So forget about all that stuff in the first teardrop point. Look down at the equal sign with an arrow. What we can do is we can rearrange this so the percentage change in the spot rate. So do you see percentage delta, percentage change, S, that's the spot rate, T plus 1. So what does that equal to? That equals now skip over the middle there and look on the far right side of the equal sign. That equals the interest rate differential discounted by the domestic interest rate. All right, so look at that second embedded teardrop point, the blue one. The expected percentage change in the spot rate is proportional to the interest rate differential. This is what I was hinting at the very beginning, and then another time or two inside of this recording, that we expect those exchange rates to change, right? Absolutely, because of trade. And this equation here tells us about the importance of the differences between the interest rates. So think about trade, physical goods and services going back and forth over a geographic border, but then think of capital flowing, US dollars and Canadian dollars flowing back and forth. So this equation, it explicitly measures and relates to the difference in the interest rates, but I promise you that that expected trade is embedded inside of this equation as well. So look down at the bottom. It says relationship, influenced by many other factors. So strategists do not rely solely on forward rates to their currency expectations. Now, the Institute is very big back in time value of money in asking the following question. All right, suppose that we have $100 today and we have a 10% interest rate At the end of 1 year, you'll have $110, right? That makes perfect sense. But what happens if we have a 10% annual rate? What's the future value after 6 months or 3 months? Or if we have 10% over 3 months, what's that as an annual rate? So this is all what the section here at the end of this learning module does. Look what we have in the very middle. Single period analogy. So all that stuff that we've done is based on probably 1 year's time. But suppose that the investment term is just a fraction of a period. Then what do? Well, we do the same thing that we did back in time value of money. Now, what I could do is I could go through all this stuff here and I could say, oh yeah, let's derive that. Let's not worry about that. You ready? Let's go ahead and work through an example. So we have 31-day, 2.5%, 31-day, 3.5%. What is that? Domestic and foreign. And then there's the spot rate. We can calculate the forward premium or discount. Well, here we go. 31 days. So what we want to do is we want to calculate that forward rate of exchange at that particular time period. So do you see how we're adjusting for other than annual compounding? So let me go back here. You ready? Do you really want to remember all that kind of stuff? Forget about it. This is so much easier. Look, let's start with the the forward rate. It equals the spot rate. So we're given that 156.30 at the top. So there we go. Throw that to the right-hand side of the equal sign. And then we're going to take the ratio of 1 plus the foreign interest rate divided by 1 plus the domestic interest rate. But we have to adjust it for the time period. So what we're going to do is we're going to take that 3.5%, which is the foreign rate, and we're going to multiply it by 31 divided by 60, then add 1 to it. And then in the denominator, we're going to take the 2.5%, which is the domestic interest rate, multiply that by 31 divided by 60, and then add 1 to it. And so if you do all that stuff, you get the 156,434. So the signal that the Institute has to give you to ask this particular question, and by the way, in the questions at the end of the learning module, this is the last one. There's only one of these questions, but it's super easy. So make sure that you can do this. So you get the 156,434. You can go ahead and compute then the premium, and there you go. Divide by multiply by the 10,000. You get 13.4 points. Some people call them pips. Now, the other way, I think it's easier to do it this way, but the other way that the Institute wants you to learn, I hope it doesn't ask you to do method 1 on one question and then method 2. I always tell my students, I don't care which method you use as long as you get it right. You can do all this. This is just that second way of doing it, and you get the 134 there at the bottom. So whichever way you like, I like this way better. I think this is easier because this is based on all the time value of money stuff that we did, a couple of learning modules ago. This one here is, of course, it's accurate, but it's based on just stuff that we did inside of this learning module. And so that takes us through these handful of LOSs. I want you to go and take, I think there's 7 questions. You don't even need 7 minutes. Get your calculator and you're going to be able to compute all of these kinds of answers. So I think you'll do really well on those questions. So, hey, thanks for watching. As always, good luck studying.